Hello, everyone, and thank you for joining us this afternoon. My name is Tony DeMicantonio. I'm the staffing practice leader at Odell Studner. Today, I'll be your moderator, and we wanted to talk to you about the ever-changing environment that's going on today as a staffing company owner with the COVID-19 crisis. As you all know, things are changing week to week, day to day, and our goal today is to be able to talk to you about some things. Thankfully, maybe a little bit less about triage than we would have been talking about a couple weeks ago, and more looking at how we're opening up and looking forward to recovery. So with that being said, I'll touch on a couple of housekeeping items. We are going to have a 60-minute webinar today with Q&A built in to the end. Please submit all questions for the panel using the chat function of the Zoom interface. I'll quickly outline some of the topics that we're going to talk about today. We're going to start off talking about PPP, Paycheck Protection Program, obviously a huge topic right now. And we're going to go into both eligibility, forgiveness, as well as additional strategies associated with it. We're going to talk about some of the legal perils of teleworking and how, as a country, we're getting back to work. Additionally, we'll be talking about business interruption claims and workers' compensation claims from an insurance standpoint, as well as some strategies for staffing companies to be able to maximize financial returns in the post-crisis world. So with that being said, I'd like to take a minute to introduce the panelists for today. First off, we've got BJ Hoffman and Mike Zaborowicz from Citrin Cooperman. Citrin Cooperman is a full-service CPA firm offering tax accounting and consulting services to clients of all shapes and sizes through the United States. BJ and Mike are co-leaders of the firm's staffing industry practice from the Philadelphia office. Citrin Cooperman provides tax and accounting services to more staffing companies than any other CPA firm in the country. Next, I'll introduce the gentleman from Becker LLC. We've got Marty Barasco as managing partner of the firm and David Sprong as partner in the firm. Becker LLC is a premier mid-market firm recognized as a leader in the staffing industry. With offices in New York, New Jersey, Philadelphia, and California, the firm provides forward-thinking, mission-critical advice to staffing industry entrepreneurs and management on high-stakes, complex legal matters, as well as day-to-day matters and long-term plans such as acquisitions and mergers. In addition to myself, we have Mark Stenson, who's a sales executive with Odell Studner. Odell Studner is a risk management consultant and insurance broker that specializes in the staffing industry. We partner with staffing companies that understand that by taking risk and adherence to operational best practices, they can stabilize their costs, reduce their spend, and increase profitability in their company. We help our staffing clients accomplish this in their workers' compensation, liability, and/or employee benefits programs. So now that we know who everybody is and what we're talking about, we'll get started. The first question of the day, direct to Marty Barasco. Marty, obviously the Paycheck Protection Program is high on the list of priorities for staffing firms right now. We saw a minor crisis erupt over the last couple of weeks concerning PPP loan recipients' potential ineligibility to participate in the program. Can you talk to us about where things stand today on PPP eligibility?
Certainly. Good afternoon, Tony. How are you today?
Great.
It's been really quite a roller coaster, a number of twists, some turns, and I think even a period of really being upside down on this eligibility issue. All in all, we've had 48 FAQs with respect to the PPP program, and the government's doing the best it can. Let's realize that it usually doesn't roll out programs of this nature this quickly. So it's doing its best to provide guidance as it can. And it shouldn't be surprising to us that this has been a bit of a roller coaster. The standard has evolved from the beginning. At first, the certification standard appeared as though it was going to be a pretty low bar for borrowers to meet. The language in the application was pretty straightforward, and it just required borrowers to certify that the current economic uncertainty makes this loan request necessary to support the ongoing operations of the borrower. And again, it just seemed like this was a pretty low bar at first, that you didn't even have to show negative economic impact. You just needed to show that you had some economic uncertainty as a result of the crisis. But that significantly changed when FAQ 31 and 37 were released by the SBA. And those FAQs were released shortly after kind of the uproar in the media that resulted from certain very large publicly traded entities applying and receiving large PPP loans. And that fact, coupled with the first tranche of money being run through very quickly, and some uncertainty as to whether or not Congress would in fact be able to refund the program, created a really deep dive by the SBA and the Treasury into really who should be eligible to borrow. And they came out with FAQ 31 and 37, and then imposed really a new test upon borrowers. In addition to the economic impact test, it imposed an access to liquidity test upon borrowers. And essentially, there became two prongs to the eligibility test. That was, one, you had to have the economic impact or economic uncertainty. Then you didn't have to, then you also had to not have available to you access to liquidity that could bridge the gap of the crisis. So in FAQ 39, the SBA made clear that it was very, very serious about this new requirement. And it indicated that it was going to review all borrowers' loans over $2 million. And the latest FAQ 46 actually provides a little bit of stability to borrowers under 2 million, because with FAQ 39, it didn't indicate that borrowers under 2 million wouldn't be reviewed. It just indicated that all borrowers over 2 million would be reviewed. FAQ 46, which came down on May 13th, so just last week, created a safe harbor for borrowers under 2 million, and basically said, look, we're presuming that folks who borrowed less than 2 million, they're smaller companies, and we're going to presume that they don't have access to liquidity, and therefore we're going to exempt them from that part of the test. But at the same time, FAQ 46 put the bullseye straight back on borrowers over 2 million, and indicated, in fact, that again, not only would it be a review, they used the word audit in an FAQ for the first time. That word had been used by Munchin, but had not been used by the SBA itself, and it does appear in FAQ 46 for the first time. It reiterated that there would be an audit for borrowers over 2 million, but it also provided some clarity as to what the initial penalty would be if the SBA found that a borrower lacked the ability to make the eligibility certification. And this was good, because it was unclear as to what remedies the SBA would try to utilize if it in fact conducted an audit and had such a finding. So what the SBA indicated in FAQ 46 was that if they found that a borrower lacked an adequate basis for making the certification, they would require prepayment or a repayment of the PPP loan, and they would not permit forgiveness. And if a borrower, in fact, repaid the PPP loan, then the SBA wouldn't seek to utilize other alternatives it had under its administrative processes or referrals to other agencies for prosecution. So at least now we know that borrowers over 2 million can, in fact, head off steeper penalties if they are able to repay the loan at the time of an audit. So that provides a little bit of certainty. At first, we were concerned about whether there might be jail time. Prosecution most likely would be under the Federal False Claims Act, and there's both a criminal and a civil prosecution provisions in the False Claims Act, and many borrowers were concerned about that. It now seems that those type of remedies will only be asserted if a borrower doesn't pay back the PPP money. So what does that mean? Bringing that forward to today. The safe harbor period of May 18th is passed, so you can no longer return the money. So now what borrowers over 2 million should be doing is preparing for their audit. And one thing that borrowers need to know, and that is that the $2 million includes all money borrowed by affiliates. It's not just the money borrowed by an individual company. The FAQ 46 specifically said that any borrower together with its affiliates that borrowed more than 2 million is going to be subject to the scrutiny. So you have to understand, in figuring out whether or not you're going to be exempt from this audit, you have to be including amounts that were borrowed by affiliates and determining whether or not that's over 2 million. If in fact the amount is over 2 million, you should be preparing for your audit. And how are we recommending that you do that? A couple of things. One, it's very important that you're documenting the evidence that goes to both prongs of this new standard. So you need to be documenting the financial condition of your company at the time of the crisis, at the time that you sign the certification to apply for the loan, and into the future. You need to be looking at what type of impact the crisis has had on your company. You need to be looking at it in terms of prospective. What are your key leading indicators? Are your orders down? Is your time to order down? Is your ability to fill orders down because you can't get workers to come back to work? And you should be documenting all that. You should be documenting any requests by your clients to increase the period in which they are able to pay your invoices or to change the credit terms between you and your clients. You should be running projections, various scenarios and projections as to what June, July, August, September may look like for your company. And on top of that, you should be examining what liquidity you have. And liquidity comes in a bunch of different forms. It can come from positive cash flow. It can come from cash on hand and retained earnings. It can come from access to other loan facilities. In the staffing industry, that's most often an asset-based loan tied to receivables. So you should be going through that with your financial staff, CEO and president, with the controller and the CFO, documenting all that information so that when you have an audit, you can show that you had the requisite need for the loan.
Marty, appreciate the insight there from a legal perspective and outlining the eligibility component. Maybe to switch things up and give it an accounting perspective, BJ, I'll ask you if you could give us just an update on where the program stands today and touch on some of the different strategies that I know are kind of all over the place at this point. Take it away.
Yeah, thanks, Tony. Happy to be here and hope everyone at home is okay. Yeah, I think Marty did a good job of outlining where we are today on the eligibility side. Before the latest guidance, had a lot of clients freaking out, and that's a technical term, freaking out over whether they were criminally liable for some of this. So a lot of that pressure has been removed, and we're happy to hear that. So obviously, this is a hot area of interest for all companies, not just staffing companies. It's at the top of everyone's mind right now, this PPP program. And if you've been following along, and certainly if you have received funds, applied for them and received them, you know that the rollout of this thing has been marred by rushed and vague and sometimes contradictory guidelines that have governed the application for the funds, the use of the funds, and forgiveness. And as an advisor, it's been incredibly frustrating in terms of being able to provide cogent and timely advice to our clients. It's almost impossible with a seemingly everyday drip, drip, drip of new regulations coming out. So Marty maybe is a little kinder towards the program than I am, but in any event, the good news here is that the program can really be a meaningful financial event for a staffing company. You know, at a minimum, the very minimum, you're talking about super cheap money. You know, 1% loan payable over a couple of years. And at best, and for most of us, we're thinking along the lines of this being a real true payroll subsidy that falls out and falls to the bottom line. You know, there's a lot of upside for staffing firms and all firms with the PPP program. So what I'm going to talk about here is twofold. First of all, we'll do a little bit of a breaking news element to this because Friday, late Friday, the SBA issued its application for loan forgiveness form, which answers not all, but a good number of our open questions about the program. So I'm going to talk about that, and we'll go over the highlights from the last couple of days, which I'm sure everyone will be interested to hear. And then I'll pivot, and we'll talk briefly about some loan minimization, forgiveness of loan strategies that we're offering to our clients. So with that, jumping into what just happened this week, or at the end of last week, and we're still reading and digesting. Clearly, what drives forgiveness of the PPP loans is largely the use of payroll for eligible expenses. But besides that, one of the key factors in any forgiveness calculation is the notion of whether or not you, the loan recipient, had a reduction in your workforce from pre-crisis to post-crisis or post-receipt of loan proceeds. So, you know, the measurement of headcount is essentially an FTE calculation, full-time equivalent employee calculation. The problem is that nobody from the government told us how this calculation was going to work. We had assumed that the FTE calculation would be akin to what was used for the Affordable Care Act, which was essentially a 30-hour work week. You know, you add up all your the hours worked in an office, divide by 30, and there's your FTE equivalent number. But no one had said anything until Friday. And it will not be a 30-hour work week. Instead, it's clear now that it will be a 40-hour week calculation. So if you have an employee who's working more than 40 hours a week, they count as one FTE. If you have an employee working 10 hours a week, 0.25 of FTE. So that guidance is super important now and really drives a lot of our loan forgiveness calculations. So it's good to have that. We also knew, as far as the payroll side of things go, we knew that highly compensated employees were going to be in some way, shape, or form limited. At least their payroll was going to be limited for the forgiveness to essentially $100,000 pro rata. Over a 2-month period, which is the measurement period post-receipt of the loan funds, $100,000 equates to $15,384. That's 52 weeks, 850 seconds of $100,000. What we didn't know was whether there would be a further cap on highly compensated employee compensation for forgiveness purposes on a weekly basis, a $1,923 maximum cap on their wages weekly, or whether it would be an aggregate $15,384 over the 8-week period. We now know that it is the aggregate. You don't have to worry about the weekly cap on a highly compensated employee, but you do need to take into account the overall 8-week cap of $15,384. Next point. This is a really big one. There was some notion that if you did not spend 75% of your loan proceeds on payroll in the 8-week measurement period after receiving your loan funds, that there would be no loan forgiveness given. Some advisors were reading the regulations that way. We were not. And as it turns out, in fact, it is not an all or nothing loan forgiveness proposition. So by way of example, if you borrow $1 million in PPP loans, some were saying that if you did not spend $750,000 of those loan proceeds within the 8-week period of receiving your loan, there would be no forgiveness. Instead, the way it's going to work is, let's say you only spend $50,000 of your $1 million loan on payroll in the 2-month evaluation period. What you do is you take your payroll costs, the $50,000, divide that figure by 0.75. And by math, that equals $66,667. That $66,667 is your maximum loan forgiveness in that scenario. So it's not all or nothing, which is a great turn of events. We were also aware that there was the concept of, as we discussed, if you have a declining headcount, this notion of a loan forgiveness haircut being possible and applied to your forgiveness if you do not restore your headcount by June 30th. We've gotten a little additional guidance on that now. What has been thrown into the mix is the date of February 15th, 2020. And if you have had a decline in your headcount, you have the ability, if you can restore by June 30th, 2020, your headcount to the headcount that you had on site at February 15th, 2020, you can sidestep that loan forgiveness haircut that's floating out there. So we got some clarity there, which was good. Here's an administrative burden that was eased in the last couple of days. As you know, you get your PPP loan proceeds and the clock starts ticking. You've got 8 weeks to spend the money on payroll and other eligible costs. That was creating a problem because that 8-week period did not necessarily align with any given company's pay periods. So there was going to be some slicing and some dicing of pay periods to show what was eligible, what was not eligible for forgiveness. What has come out now in the last couple of days is an alternative covered period, it's called, and it applies only to the payroll component of this whole calculation. What it says is, in lieu of being compelled to use that 8 weeks starting with the date you got your loan funds, you can instead measure your loan forgiveness on the payroll piece by using an 8-week period that aligns with your pay periods. So that should relieve some burden on recipients of funds from an accounting perspective. Finally, we now know that rent expenses, which we always knew were essentially forgivable to some degree. Rent is not just office rent, but it's also potentially the rent of tangible personal property like postage meters and copy machines and even auto leases, as long as the leases were in place as of February 15th, 2020. So those are the headlines from the last couple of days. And they are, in fact, very helpful in many ways. There are unknown questions still, and there will be further guidance coming, which is what I say all the time. Now, pivoting to what we're talking about in general terms about maximizing loan forgiveness with our clients. First of all, we know that paying eligible payroll is the big driver of forgiveness by calculation. So we also know that you can't load up on executive compensation because there's a limit of $15,384 in pay for any highly compensated employee in terms of the forgiveness calculation. An open question that is yet to be resolved is whether or not the payment of bonuses during the 8-week measurement period to other staff is or is not eligible for forgiveness. As of right now, it's a big gray area, and I would expect that there would be some guidance given in short order on that. However, I think the notion of things like increasing your contract workforce for hazard pay, for example, probably stands a good leg if it's to stand on. You have a good leg to stand on if you're challenged there, and that may be a mechanism by which you can increase pay and increase forgivable payroll. However, I would caution you to not restrict hazard pay to the 8-week measurement period and then have it go poof, gone. You really need to have it extend beyond the 8 weeks so that when someone looks over your shoulder on this thing, they know that this is not just a scheme to maximize loan forgiveness. So we're talking about that with clients. Now, 2 points on this FTE, 2 very important points on this FTE calculation and forgiveness haircut, one of which is brand new in the last couple of days. I talked to you about how you measure FTE. It's a 40-hour work week. If you work over 40 hours, you're 1 full-time employee equivalent. If you work 10 hours, you're 0.25. You can go person by person and calculate the way I just indicated. Alternatively, you can instead treat anyone that worked over 40 hours a week as one full-time FTE, and anyone that worked under 40 hours in a given week as a half FTE. So you don't need to calculate the exact amounts for each employee that worked under 40. That, on one hand, may make things slightly easier from an accounting perspective, but more importantly, you need to calculate it both ways. Both are acceptable. You have to be consistent, whichever method you use, you have to be consistent, but one may lead to a different FTE headcount for you that may dramatically change the forgiveness haircut. So watch out for that, and that's something we need to be digging in on in the coming weeks. Also on the FTE, and this is a bit of older news, but we really emphasize this to our clients, is the notion of whether your headcount dropped pre-crisis to the period where you received your PPP funds. You have the choice, absolutely your choice, to use as a base historic measurement period the FTEs that were either in place for you from February of 2019 to June of 2019, or alternatively, you can choose January 1st, 2020 to February 29th, 2020. Choice is yours for the FTE base period. Obviously, you want to analyze both, and you want to use the one that results in the lower FTE headcount, because the lower base period, all things being equal, if you've experienced a reduction in headcount, will mean a lower percentage rate decline and a lower forgiveness haircut. So we're really focusing on that with clients. Next, the guidance that came out in the last couple of days indicated that rent and utilities are, of course, eligible as forgivable expenses. But now there is a notion of potentially, again, guidance to be coming, potentially using rent and utilities that may be unpaid before the period you received your PPP loans and paying them during the 8-week measurement period and having them actually qualify for forgivable treatment. Conversely, I would probably not prepay huge amounts of rent and utilities before the end of the PPP period in order to cram in additional expenses. And that would be against the spirit of the rules and probably will be disallowed as forgivable. But back expenses that are unpaid, the door is currently still open on those. Finally, how to maximize forgiveness, and this is key, so key, keep good records. You're going to need to submit the records. You're going to need to be able to prove how you calculated your forgivable loan amount. You need to work with your payroll service provider and really be able to slice and dice these all this data in an efficient and effective way, and just keep good records. So I realized that I just crammed a whole lot of information into 10 minutes or so, but there's so much out there, and it really warrants a much longer time. But there you have the headlines, and you have our basic advice for now, Tony.
Great. Super appreciate you giving us those updates on the regulations, BJ. And I thought your examples and application of some of those strategies was spot on. So thank you. I guess keeping it on the accounting side, Mike, you just heard from Marty and BJ on eligibility and forgiveness of the PPP. When we get through the PPP loans, what do you see as being the next steps for companies to navigate the crisis?
Yeah, Tony, thank you. And I think Marty and BJ did a wonderful job covering two of the biggest topics discussed these days. We can spend hours, like BJ said, going through PPP loan application and the rules, and we'll certainly do our best to cover all the PPP related questions you might have. And although forgiveness, and rightfully so, might be at the forefront of everyone's mind, I think that as we come out of the PPP loan process, and I think a lot of people are in weeks 4, 5, and maybe even 6, there's some looking forward past, the PPP loan program. And there's some other considerations that, business owners should be mindful of as you navigate this crisis. I do want to, touch on what BJ said is, the PPP documentation is quite onerous. And so now is the time to start. You have 90 days from, loan receipt date to submit this the application with the supporting documentation. So don't wait to the last second, and some of the documentation that you need might sway which, payroll period, start date you select. So do that. BJ also talks about maximizing, forgiveness, and he's absolutely right that that's a strategy, that's the right strategy for some. It makes sense. We do caution against chasing forgiveness. And what we mean by that is, packing in expenses during the 8-week period just to have it forgiven. Again, for people that are operational and moving along, I think that makes sense. However, if you're in an industry or vertical, such as hospitality, such as restaurant, that might not necessarily make sense. And you might be able to take this cheap capital and use it. You might be better served using it, during a ramp up period. And we'll touch on that next. But I think people are getting very creative in how to bring costs into the covered period. Unfortunately, once the money's gone, it might not be there when you really need it. So it's just a consideration for some to decide whether, pack it in and be forgiven or use it during, a ramp up period. It brings me to a second consideration, which is, keeping with the basics of dealing with financial crisis, right? So at the onset of this pandemic, I think most companies were looking for ways to preserve cash. And that meant, cutting back on spending, optimizing internal payroll levels, looking at funding sources, and evaluating, opportunities that were presented by the new legislation. So you had the emergency interest, the EIDL loan, you had the PPP loan, you had the Main Street loans, tax credits, right? And so, in order to make the informed decisions, companies needed to prepare cash forecasts or what we like to refer to as 13-week cash flow forecasts more specifically. And these were vital to companies, and how else could you accurately decide how deep to cut or how much additional funding you needed? And some companies were already doing it. Others, I think, started to do it. But a lot of companies, I don't think we're still doing it. And so then the PPP loan program came along, and it became a very obvious option for those that, that qualified. And as part of the PPP loan process, I think companies really started to do cash forecasts, over the 8-week period without even realizing, right? The eligibility issue caused many to dig in on liquidity. Eligibility costs were broken out, by week. And so as you continue to deal with the uncertainty of this environment, especially if you've got the PPP loan, it's more important than ever to analyze how you manage your cash flows. A rolling 13-week cash flow forecast will just, be an extension of what you're currently doing, for the covered PPP loan period. It will provide you with an understanding of anticipated sources and uses of funds over the next 90 days. And so as you're putting this together, or, you're working with somebody else to put this together, here's some considerations to be mindful of. On the receipts side, there's generally a trend of slowing cash collections, right? So how is your receivables? How are they aging? You have customers that, probably in heavily impacted industries and areas. Some might be going through bankruptcy. It's vital to reach out to them and to find out where they are. I'm sure you have customers ask you to extend payment terms, and if you have an asset-based loan, how is this affecting your borrowing base? Have you reached out to your lender and asked to extend eligibility terms over 90, over 120, right? And as you look at other sources of funding, you might come to the conclusion that, hey, I might need to kick in some additional personal money. Well, be mindful that the extended tax period is coming in, and business owners at times will have to take distributions to pay their taxes. So if you need to put in money, how does that square with taking out money too, right? Quickly on the expenditure side, what is essential and what can be pushed? We always talk about negotiating with landlords, and landlords have been open to either pushing rent payments or using your deposits as payments. But now as we become more virtual, can you save on space? Do you need the same amount of space, right? Compensation levels, revisiting that, especially for maybe your salespeople, making it more incentive and tied to performance. I think that there eventually is going to be a hunt for, top management level. There's going to be a lot of competition. How can you keep management at this point as you come out of this? Profit sharing might kind of come to mind, right? So all things to factor in, in your cash flow. As you start to ramp up, there's a cost to rehire. There's a cost to retrain. Again, when we circle back, are the PPP funds better used during this ramp up period where you retrain, where you rehire? And then, the cost of social distancing guidelines. Dave Sprung is going to talk about, some things to consider, but you're probably going to have more supplies that you're going to need. Cleaning, how frequently are you going to do that? Workspaces, are there even, are your workspaces even functional at this point? If you had hoteling or open workspaces, are you going to have to rearrange them? And then work from home, are you going to have to provide employees with additional equipment, as work from home becomes more prevalent? All things to consider when you're doing these cash forecasts. Update them on a weekly basis, compare them to actual. You can also extend this to cash projection. Cash forecasts are essentially most likely outcome. Cash projections, you look at various different scenarios. And again, I think that, both of these are part of, a overall strategy that companies are using, an overall business plan. And business owners should be asking just general questions tied into this, right? So, is your current business plan set up for crisis management, right? More specifically, is your business model set up to handle this crisis? Or do you need to have to adapt? Do you have to get into new business lines, maybe new verticals within your current, business lines? And employees are nervous right now. Are you communicating the strategy to your employees, right? When it comes to employees, are they in the right roles? One thing that was prevalent before this was robotic process automation, which basically automated very rudimentary processes so that you can, push it, your well-performing employees into more productive roles. So, as you do your budget, factor in, do I have the ability to invest in some of this? This is the future, for all industries. And then most importantly, you have a panel of experts here, and everybody here has been helping, their clients and contacts through this. So, ask yourself, do you have a relationship in place with strong external advisors that can help you answer these questions, right? A lot of service providers provide commodities, which become a lot less important during this time. But are they providing you with the value-added service to help you come out on the other side stronger? So all considerations, the next step, the what's next, I think that these are all things to consider as we kind of come out of this PPP loan, process.
Thanks, Mike. Certainly a lot of discussion points and a lot of strategies that employers should be having with their leadership teams as they move forward here. So appreciate your insight there. The next question is going to be for Mark. Mark, we just talked about a possible source of relief in the door for staffing companies as it relates to the PPP loan. What, if anything, can staffing companies count on when it comes to claims dollars under the business interruption policies?
Thanks, Tony, and thank you everybody for joining. So the answer is more or less twofold. Is business interruption covered under a property policy? The short answer is typically no. Historically, there are two aspects to a business interruption policy for it to be triggered. The first is physical damage that's associated with the location, and the burden of proof is on the employer. What's happening with the coronavirus is the virus itself is not causing physical damage to the location. It is the fear of contracting the virus, which has caused the government to essentially ask business to close their doors. So that's the first piece, and one of the reasons why I said typically no. The second part is I would just couch that with it's subject to change in the future. This is changing every week, and it's a state-by-state case. The second part of it is the virus exclusion that is embedded within a majority of business interruption exclusions. And that does count towards common illnesses such as the virus itself, COVID-19, and the flu. And it falls in that same bucket. So those two facts coupled together, insurers are pointing back to the contracts within the policy and saying, look, sorry, but there's just no coverage for those two instances. Now, given the uniqueness of the coronavirus situation, it's caused a lot of financial impact on these employers. So the government is looking to, and they're discussing this at the Supreme Court level, to create a backstop to provide some sort of financial relief for these businesses that have had to close their doors. I read an article yesterday, I'll quote it right here. This was a New York judge who denied an appeal for a business interruption claim and ruled in favor of the insurance carrier. She says, and I quote, There is no damage to your property. The virus damages the lungs. It does not damage printing presses. That was just a short little excerpt that really stuck home with me. That's an example of what I was talking about on the physical damage side of things. You couple that with the virus exclusion, which is the big part, because that does exist in most policies on the business interruption side. There's going to be very little claims dollars being paid out just for that fact alone. And then taking it a step further, right now I was reading a study, and if you take the small business employers in our country, which are under 100 employees, the amount of business interruption claims that would be paid out is $250 billion to $340 billion per month in business interruption claims. If you expand that to include all employers of all size, regardless of employee count, it's $1 trillion to $1.1 trillion per month in business interruption claims. And you're talking about an industry surplus of $800 billion. The insurance industry would be insolvent within 3 to 4 months. So with that being said, I don't see state senates reversing the contract language, one, because it's a direct violation of the Constitution under the contract provision clause. So that's the first piece. But just given the uniqueness of the situation, there is a federal backstop that's being discussed. Nothing's been approved or enacted thus far, but I do think down the road there will be some relief. Right now, my suggestion is keep an eye on your individual states, talk to your insurance brokers, understand what the ramifications are state by state, knowing that most of the staffing companies on this phone call operate in multiple states. So don't just focus on your domiciled state, focus on the states that you are operating in. And again, the short answer right now is no, but subject to change in the future. And I do feel confident there will be something in place. So stay tuned. Hopefully that answers your question, Tony.
Yeah, thanks, Mark. Appreciate your feedback there. And, people might not always like the answer they hear, but I think as long as the expectation is set, which you did appropriately, not to count on dollars today, and unless something happens at a bigger level at the government level, they can at least plan accordingly at this point. So thank you. Switching gears a bit to some operational strategies, I'll ask David this question. Obviously, there's been a huge shift to remote workplace at this point during the pandemic. Do you expect this to continue? And if so, what best practices should employers adhere to protect themselves as well as their employees?
Thanks, Tony. It's great to be here, and thanks everyone for your attention. Yeah, I think, we talked about how we were in triage for a while, and we all just started remote working immediately when the pandemic hit, or when we really just first heard about the pandemic. That was the first thing we did. But I think that this will be the new normal, especially in sort of white collar type work. Even as late as, or as early as the late part of March, companies were already talking about moving 5% of their workforce to permanent remote positions. And I think that's going to go way up. But there's really two parts of it. One is whether the remote positions are going to be permanent. And the second part is whether or not this is going to last now for 2 months, 4 months, the rest of the year. I know one of the biggest staffing companies in the world has just said that their recruiters are not coming back to the office for the rest of this calendar year. So we're already seeing people implementing longer term remote work policies. And so I think that not only is it going to be here with us permanently, and and Mike talked a lot about how you might even want to think about, from a cost management perspective, sending a lot of people home and reducing the amount of space. And that may be something that we have to consider, but there's also a competing problem we'll talk about, and that is social distancing within the workplace. But for now, I think that the thing we have to look at is that Tony used the word at the very outset, triage. And so when we sent everybody home to work, we really didn't have any policies at the time. 78% of the companies even then allowed some type of remote work, but only 20% had policies. And since then, more and more work is being done, and less is being done with policies in place. So policies are really essential to be able to not only protect yourself from liability, but to also communicate the kinds of things that will help your employees be successful in the longer term. So when you reassess how you're doing your remote work with your people at both, depending on your segment of the industry, whether your internal or external employees, you need to first of all try to make a written policy that reflects the way things have worked over the last 2 months, together with the way you want things to work going forward, and the way the things you've learned and the things you've read and the things you hear from your trusted advisors about how to best implement these things. So I think the policies that you have to implement need to be written, and they're essential. And just like any other policy, you need to establish both policies that are on their face and in their practice, even-handed and non-discriminatory. So there needs to be some legitimate reason, and we call it in the employment world and legitimate non-discriminatory reason for why some people can work from home and others can't. And in fact, there may be those legitimate reasons, but we need to think that through and delineate clear rules as to why certain positions require or are best suited for work from home. Now, some of that in the short term is built into the stay-at-home and essential business orders, right? A lot of the non-essential businesses, non-retail, non-manufacturing, still in a lot of states require people to work from home. But once we start to roll into a new normal, and once those stay-at-home orders become lifted, I think we really have to consider, you know, whether some people are going to want to come back, some people are not going to want to come back, but more importantly, what jobs we think are suited to come back and what jobs we want to continue to operate from a distance. So first thing that you need to do is make sure that your policies reflect your workplace and that you communicate them clearly. They need to be added to your handbook. They need to be sent out by email, and they need to be sent out through the normal methods of communication that you have with your employees from the remote work environment. And we need to talk a little bit about that later too, is the best human resources management or employee relations factors that you have to consider in a remote environment. But for now, you know, we have to think about things like timekeeping. Timekeeping is essential. People still have to be paid for overtime if they're non-exempt, whether they're working from home or not. And for example, if they need to not be working on their meal breaks and on their other breaks, because then it's not really a break. So you have to have a clear policy that delineates that while they're on their breaks, they're not supposed to take an email or answer a phone call, and because otherwise those kinds of things can get you in trouble down the road if you have issues with your employees. Now, I try to keep abreast of all the things that are happening with COVID-related litigation. And one of the 5 areas that everybody who does a top 5 list thinks about wage and hour claims as the one thing that's going to explode after we all return to the new normal. And so the best way to keep track of your wage and hour claims is to make sure you have a clear policy on how timekeeping is done, and meal breaks, rest breaks, and even certain expenses for telework. How you administrate that and how you keep track of that is going to help you to maintain not only productivity, but to avoid liability from wage claims that might come later on. We haven't really, you know, a lot of my clients really didn't think about this and don't have a policy in place. And so even though you're doing it, it's best to have a written policy that reflects what you're doing. So, you know, you also have to even consider in your remote work policy or your telework policy issues of safety. You know, everyone's home becomes their workplace, and the question is whether if someone gets injured at home, whether your workers' comp policy will be in place. So with even just a 1 page about your about safety at home, making sure that they have the right equipment, making sure that they keep themselves safe at home while they're working, that can help you to get the coverage that you need if someone does in fact get injured. Now, another thing you have to consider in your remote work policy is data security. I mean, you know, you have to discourage the use of public Wi-Fi as best you can. You have to try to use VPNs and other networks to protect your information. So we all spent a lot of time securing our networks in our offices, but now that everyone's home, you need to reassess and communicate to your employees how to keep that information secure from their remote working environment. So you need encryption, you need potentially encrypted emails, you need software and hardware upgrades for your employees. Sometimes people are using, old, even older Windows versions that may not have as good protection against security breaches. And also, at home now, hackers are really attacking the home workforce and doing things like providing COVID-related information, or even offering home delivery of both goods and services and food, and using those to hack into home computers, with the ultimate goal being to hack into the company's computers. And so you need to have data security as part of your policy as well, to make sure that your data stays protected, even though you're in this at-home environment. So, Mike talked about it a little bit, but a lot of what I wanted to talk about is the near term, which is now. What kind of policy do you have in place for remote work, which we're all doing now? And do we have to consider internal and external employees? Then there's the next phase, right? None of the phases of what I've seen from stay-at-home orders include a white-collar return to work. So a white-collar return to work, certainly if you're placing people in essential businesses, they're already out there in the workforce. But a white-collar return to work is probably months away. And then there's the third phase for companies, which is to determine whether this is going to be permanent. Whether you want, even once we reach the green zone and everyone goes back to work or is allowed to go back to work, do you want to create, as Mike said, some of these internal policies to allow people to work there permanently? But then you also need to have a policy for when people return to work. And Mike touched on it briefly, and I know I'm sort of running out of time here, but for the return to work, you need to offer all kinds of safeguards. You need to be closing meal rooms. You need to be closing kitchens. You need to really be careful about meeting rooms and making sure that people are socially distanced at 6 feet apart. You need to maybe stagger work times, stagger times people are coming in and working, to try to keep people separate. Space over the last 5 years has compressed. We all want to work in a compressed environment, in a mutual environment. We have an office in the city that has carols and a great view of the Empire State Building, and everybody wants to work there in sort of collaborative spaces. And I think we might need to move away from that a little bit in the near future, especially. So those return to work policies are important too, in terms of making sure that you really clearly state, if you're sick, you have to stay home. Maybe you even want to start taking temperatures. And so there's lots of things to consider, Tony, in both working remotely and in returning to work that require you to assess where you are, where you want to go, and write that down in a policy, just like you have a 50-page handbook for every other aspect of what your workplace looks like. Now this is part permanently of your workplace.
Great. Appreciate that, David. And yeah, absolutely. Teleworking will be part of the new normal going forward. So appreciate your insight on those best practices there, which will help prevent all employers from risk and ultimately have things structured as best as possible. Last question for the panel before we open things up for Q&A. Mark, one of the other landscapes that's changing on almost a daily basis is in regards to filing workers' compensation claims and employees being able to cite that they contracted COVID in the workplace. How do employers know if these claims will be compensable at the end of the day or not?
Yeah. Good question. A little bit of a convoluted question in the sense that it does depend state by state. Workers' comp policies do typically pay out for occupational diseases. However, they do exclude common illnesses such as a cold or the flu. And right now, COVID-19 claims would count under that bucket. Now, workers' comp is a very employee-friendly policy. And so what insurers are doing and what the government is also doing is looking to ease the burden of proof on the employee when it comes to submitting a claim. So I'll use California as an example because this is a recent one that popped up in my head. So Governor Newsom has enacted, they're already doing this in California, has enacted a presumptive bill, which basically declares any employee is deemed an essential employee if they were required to work away from home. As long as they've contracted the coronavirus, they're going to get the benefit of a doubt when submitting a workers' comp claim. And that is huge because the broadness of that definition expands across multiple industries. It doesn't matter what the occupation is or what the employee is doing. As long as they've contracted COVID-19 in the state of California away from home, they're going to get the benefit of the doubt, and they're going to be entitled to medical care, and they're going to be entitled to indemnity and the other benefits of workers' comp. So that's California. I'll use New Jersey as another example. New Jersey has submitted similar language. Unlike California, it has not been enacted upon yet. It's been approved at a committee level. The state Senate still needs to approve it. The definition is very similar with New Jersey. However, they are including, and David touched on this a little bit, but they are including working from home as an essential employee. So not only is the list of what's considered essential very broad, but they're not only counting working away from home, but also working at home. So they're trying to provide some relief for these employees that are on the front lines working and providing essential services for our country. They're trying to provide benefits. So that's what you're going to see. It is a state by state basis. As I mentioned, New Jersey, it's still up in the air at this point. It's being discussed on a weekly basis. Illinois has put similar language on the table, but that has since been withdrawn. So my advice is, similar to the business interruption, understand what's happening in your domiciled state, and then also understand the impacts on a state-by-state basis and what you conduct business in. And it might be a little tedious, but the benefits definitely outweigh the work on the front end to be able to calculate that. So hopefully that answers your question, Tony.
Yeah, great advice there, Mark. I think understanding what's happening at the state level is crucial to be able to then plan for what you might find in your business. And, and I'd encourage you to check with your advisor, check with your broker if you need help in understanding and navigating that state by state difference there. So with that being said, that concludes our panel discussion, and we do have time left on the Q&A side. So I'll just start by reading the first question that came through. And I'll throw this to both the legal and financial guys here on the call. Do you think that the bill to extend forgiveness from 8 to 16 weeks will pass? If so, please discuss how it might impact the use of funds.
I don't know. How's that for an answer? There's talk of it. It kind of makes sense, particularly for certain hospitality industries where you're trying to deploy money when businesses really aren't open or able to open. So it makes sense to extend that measurement period beyond 8 weeks. Whether it'll happen or not, total speculation. Mike, what do you think? You're on mute. There you go.
Yeah, no, I think, BJ, you're right that there are certain industries like the hospitality and restaurant industry that are pushing for this very hard because, at this point, they're closed. So you're going to be bringing back employees to minimize forgiveness, but they're going to be sitting at home. So for them, it doesn't really make sense. The program as it's structured, it's a very effective lobby and they're pushing for it very hard. Whether that, that anything comes out of it is unknown.
Yeah, I think you have to assume that it won't be extended. I would use that as the safe bet.
Great, thank you. We've had a bunch of other comments come through on the chat side, not as many questions. So at that point,
Tony, a lot of the questions we tried to answer as we kind of go along. There are a couple of questions, and Marty, there's one in there, I think, regarding eligibility for, PPP with regarding to standards. I don't know if you want to take a look at it or you want to take a look at it. And then there's, I think, also a question for Dave about work from home locations, if you guys want to take a look at those questions. Otherwise, to highlight the questions that were answered, I mean, BJ and I think we tried to go through some of them. You know, for those that, you know, you can pop up the questions at the top, you know, for I think one of them, BJ, you answered, you know, with regards to leased equipment. I think that's doable. I think, you know, Mark asked about financed equipment as well. Other than that, again, our answers are all in here. If we didn't get to your question, I think that, you know, what we can do is we have your information. We can reach out to you afterwards to make sure that any ones that weren't answered could be addressed, you know, after the fact.
Yeah, and you know, what I'll say in closing here is, one, I appreciate everybody tuning into this, and I appreciate the panelists all giving their time and feedback here. I think the best advice is, as we've learned here, we really need to stay abreast of all the changes that are taking place, not only at a weekly level, but at a daily level here. Lean on your advisors for assistance with that. And also know that this group is going to make sure that we continue to drive some regular updates out to everybody as well. So with that being said, thank you again, and talk to everybody soon.
Thanks, everyone.
Thank you.
Thanks, everybody.